This is a CoinGlass liquidation heat map of Bitcoin on July 15th. Look at the far right edge. The green candlesticks punch upward, tearing through the $65,000 resistance level. Immediately after, the surge leaves behind a massive, dark purple void where liquidity used to exist. Standard volume and momentum oscillators are reactive. They capture a structural shift of this magnitude only after the move is complete and the capital has already moved. But the structural fuel required to trigger this specific move was sitting in plain sight, mapping the potential trajectory days in advance. To understand how a market engineers a liquidity cascade of this scale, we are going to reverse engineer this breakout using liquidation heat maps. Algorithmic trading systems constantly map the order book, probing for vulnerable pockets of highly concentrated, over-leveraged retail capital. This is the magnet heuristic. Large entities requiring deep liquidity to execute size without slippage treat these high-leverage liquidation zones as gravitational magnets. By tracking the accumulation of these high-density leverage pools over the preceding week, we can identify a clear directional bias in the market's internal structure. Understanding these underlying market maker mechanics provides the necessary context to differentiate between volume spikes and systematic liquidity sweeps. This is the same heat map rolled back to July 9th. Notice the distinct bright yellow bands residing above the price at $63,000 and below at $61,000. That bright yellow color indicates highly concentrated estimated liquidation prices, representing massive clusters of 50x to 100x leveraged positions. Watch the initial downward vector. The market seeks out that lower liquidity boundary, pushing price down until it aggressively taps the $61,000 yellow level. Once that lower leverage pool is consumed, the localized selling pressure evaporates. The price immediately snaps back, resulting in a sharp upward move above the $64,000 line. Having swept the bottom, the market enters a temporary state of equilibrium, consolidating near the upper bounds between $64,000 and $65,000. This early week behavior establishes our range-bound baseline, where algorithms sweep local upper and lower boundaries to clear out weak leverage. Fast forward to July 13th. We observe a distinct shift in behavior as the price begins a sustained decline back towards $63,000. The market executes a targeted downward sweep. A sharp candlestick drop cuts straight through the immediate $63,000 support structure. This localized sweep flushes out late long positions, effectively clearing the bottom of the order book. With the price suppressed and short-term support broken, aggressive short sellers are enticed to enter the market en masse, expecting further downside. The immediate consequence, stop losses and liquidations begin stacking aggressively above the current price. Notice the massive, uninterrupted yellow bands stretching from $63,000 to $65,000. Compared to previous days, this uninterrupted density represents a staggering volume of trapped capital. Trapped short sellers have now effectively manufactured the structural fuel necessary for a massive upside cascade. Moving into the critical compression phase on July 14th, the price action stalls. It rebounds slightly off the $62,000 support line, but remains suppressed right beneath the main liquidation bands. The chart shows intense underlying saturation, while the market is forced into a tight sideways constraint. The price climbs towards $63,000, trapped directly under those massive yellow overhead clusters. The execution logic is strictly mechanical. The moment price taps the lowest boundary of this pool, a wave of forced liquidations will trigger. Because a liquidated short position requires the account to buy back the asset, these liquidations translate into automated, highly aggressive market buy orders. This is the exact mathematical vector where the ignition begins. The price breaks upward through $63,000 resistance and enters that first high-density liquidation cluster. Because each triggered liquidation buys back into the market, it pushes price into the next tier of liquidations, creating a self-reinforcing feedback loop that defines this breakout configuration. Bringing the analysis full circle, we return to the explosive July 15th breakout. The price climbs towards $66,000. Watch it punch through the bands. The thick yellow concentrations instantly turn deep purple as price shoots through, vaporizing trapped capital. The clustered short liquidations converted directly into the buying pressure required to sustain such a massive upward move. The July 15th breakout represents the mechanical resolution of a hypersaturated liquidity pool. This demonstrates the informational advantage of observing structural liquidity data. A traditional price chart shows where the market has been, but the heat map reveals the mechanical magnets dictating where the market must go. By identifying exactly where the maximum leverage is clustered, quantitative analysts can actively position for these inevitable market cascades. Modern market breakouts frequently function as algorithmic hunts designed specifically to consume concentrated leverage.